Okay, let's get into this. You've got these financial statements in front of you, right? Piles of numbers, sales, costs, assets, debts. But how do you actually figure out if the business is, really doing well or maybe struggling? We're doing a deep dive today looking at an article that tackles exactly the challenge of interpreting financial performance. It's less about the calculation and more about understanding the story behind the numbers. So our mission here is to get past just the figures. We want to help you see the narrative. Is the company healthy? What moves is it making? Where's it likely going? Because honestly, whether you're reading a company report, thinking about investing, or you're just curious, getting this stuff helps you cut through the noise, the jargon.
Absolutely.
It's not about memorizing formulas, is it? It's interpretation, context.
Yeah, exactly. And that's right at the core of the source material we're looking at. Assessing performance, it's not just plugging numbers into a calculator. It really demands proper interpretation. You have to see the information in context.
Right.
Just saying, profit went up 10%.
Right.
Well, that's not analysis, is it?
No.
You need to understand why and what that actually means for the business going forward. The article points out that a really common weakness in analysis is maybe a lack of commercial awareness or just failing to link the numbers back to what's actually happening in the business, the specific situation.
Yeah, that specific situation point, or the scenario as the article calls it, that feels really important. The source hammers this home, any extra notes or details alongside the main statements. Maybe they sold off a big asset or bought another company. That information isn't just background noise.
No, it's critical.
It's absolutely crucial, right? It's the backstory. You have to weave it into how you read the numbers.
Absolutely. Let's take a classic example the source uses. Imagine a company sells off a major asset during the year. Now, that single event sends ripples through the financials. On the profit or loss statement, you'll probably see a profit, maybe a loss, just from that sale.
Right, the disposal itself.
And in the cash flow statement, a big chunk of cash coming in.
Makes sense.
But then look at the ratios. Your asset turnover, that's revenue compared to your asset base, that ratio would likely look better. Why? Because your asset base suddenly shrank.
Ah, okay, smaller denominator.
Exactly. And return on capital employed, ROCE, that'd probably look better too for similar reasons. And this is the crucial context. The source highlights that asset sale. It's usually a one-off.
Right. Doesn't happen every year.
Precisely. So it makes the numbers look good this year, but it's not part of the regular business. It can really distort the picture if you compare it to past performance or try to predict the future based on it.
So it's potentially misleading.
It can be. The analysis in the source suggests you might even want to try recalculating key ratios without that one-off item, just to see the underlying trend. Or, at the very least, you absolutely have to comment on how that disposal affected the results you're presenting.
That makes a lot of sense. So a big sale can make things look temporarily rosier. What about other big changes the source mentions, like revaluing assets upwards or buying a whole new business? How do they play out?
Good questions, because they often push ratios the other way. Take a revaluation, say a company decides its property is worth much more and increases its value on the balance sheet.
Okay.
That immediately increases the capital employed figure. Now, if profit and revenue haven't changed, what happens to ROCE and asset turnover?
They'd go down, wouldn't they? Bigger denominator again.
Exactly. They'd likely reduce. And the article points out this doesn't necessarily mean the business is suddenly less efficient or less profitable in its operations. It's more of an accounting change hitting the base figure used in the ratio.
So context again.
Always. And it's similar with a big acquisition. Buying another company boosts your asset base, your capital employed. So initially, asset turnover and ROCE might actually look worse. Particularly, as the source notes, if that acquisition happened late in the financial year.
Because it hasn't had time to contribute much profit yet.
Right. You've got the full cost, or at least the cost from the acquisition date, swelling the capital base, but maybe only a few months of revenue or profit from the new part of the business have flowed through. So you really have to consider the timing. And the future potential of that investment might pay off handsomely down the line.
It really drives home that you can't just react to the number changing. You've got to ask why. The source also talks about management actively trying to improve things, right? Like using customer rebates.
Yes, the rebate example is a neat one for showing trade-offs.
How so?
Well, offer your customers rebates, and sure, sales volume might go up. People buy more to get the discount. Revenue figure looks higher.
Sounds good.
But the rebate reduces the net price you get for each item sold. So while revenue might increase, your gross profit margin the profit on the direct cost of goods is likely to fall.
The percentage profit on each sale drops.
Exactly. So the article pushes you to ask, okay, management did this, but was it actually effective overall? Did that extra volume make up for the lower margin per sale, or did overall profits suffer?
Right. Okay. So understanding the scenario, the context, the why, that's step one. Then the article dives into the actual tools, the financial ratios. It groups them into what? Profitability, liquidity, and gearing.
That's right. And it mentions investment ratios exist, but doesn't go deep on those in this piece.
Yeah.
So profitability is usually the first stop.
Makes sense. Is the business making money?
Pretty much. And the key measure the source focuses on here is return on capital employed, ROCE.
Okay, ROCE. How's that calculated again?
The standard formula is profit before interest and tax, PBIT, divided by the total long-term funds invested. That's essentially shareholders' equity plus debt.
Got it. And what does it tell us?
It's a core measure of how well the business is using all that long-term money tied up in it to actually generate profit. Generally speaking, a higher ROCE or an increasing ROCE is seen as an improvement, better returns.
Oh.
But here's where it gets interesting, and the source really emphasizes this for deeper insight. ROCE itself is driven by two other things: your profit margin and how efficiently you use your assets, your asset turnover.
So ROCE is like a headline figure, but you need to look underneath.
Precisely. An improvement in ROCE could be because you're making more profit on each pound or dollar of sales, or it could be because you're squeezing more sales out of the assets you have, or maybe a bit of both. You need to check both components.
Okay, so let's break those down. Asset turnover.
Asset turnover is your revenue divided by your net assets, which is usually total assets minus your current liabilities.
Right.
It tells you how much revenue you're generating for every pound or dollar invested in your operating assets. Are you working those assets hard? The source notes that changes here obviously come from shifts in sales or changes in the asset base itself.
Like the examples we discussed earlier.
Exactly. More sales boosts the ratio.
Yeah.
But also, doing something like a sale and lease back, selling a building then renting it back, that shrinks your asset base on paper and can make asset turnover look better, even if underlying sales haven't changed much.
Okay. And the other piece was profit margins.
Yes. The article looks at two main ones: gross profit margin and operating profit margin.
Gross first.
Gross profit margin is your gross profit, that's revenue, minus the direct cost of sales divided by revenue. It reflects your basic trading performance. How well are you managing the direct costs of what you sell? Things like raw materials, direct labor.
And what affects that?
The source gives examples like having to write down inventory because it's old or damaged. That hits your cost of sales. Or changes in exchange rates making imported goods more expensive. Price changes, volume changes, cost changes, they all feed in here.
An operating profit margin.
That one usually uses operating profit, typically PBIT, again divided by revenue. This margin reflects how well you control all your operating costs, both the direct ones in gross profit and your indirect overheads. Things like rent, admin staff, marketing costs.
So it's a broader measure of cost control.
It is. And the analysis advice from the source is to always connect the two margins. If your gross margin falls, you'd normally expect your operating margin to fall too, right?
Yeah, unless something else changes.
Exactly. So if gross margin falls, but operating margin holds up or falls by less, maybe the company did a great job cutting overheads. Or remember that asset disposal profit we talked about?
Yes, the one-off gain.
That kind of gain often gets included in operating profit. So it could be artificially propping up the operating margin, masking weaker performance in the core business shown by the gross margin. You have to dig into the notes.
Okay, so profitability unpacked. Lots to consider there. Let's shift to liquidity. This is about, can the company pay its bills, basically? Its short-term debts.
Precisely. Can it meet its obligations as they fall due in the near future? The main ratio the source discusses here is the current ratio.
Current assets over current liabilities.
That's the one. Current assets, things like cash, receivables, inventory, stuff expected to turn into cash within a year.
Yeah.
Divided by current liabilities, debts due within a year, like payables, overdrafts, short-term loans. And
there's like an ideal number for this, isn't there?
Well, the source mentions the old textbook rule of thumb, maybe 1.5 to 2.1, meaning you've got £1.50 or 2 pounds of current assets for every 1 pound of current liabilities. A nice buffer.
God.
But, and the article really stresses this, that ideal is massively dependent on the industry.
Right.
Think about a supermarket versus a software company. Very different inventory levels, different payment cycles. A service business might have hardly any inventory or receivables and operate quite happily with a current ratio below 1.
So comparing to the past or others in the same sector is key.
Absolutely. Context is everything. Don't just apply a generic rule.
Okay. And there's another liquidity ratio, the quick ratio or acid test.
Yes, that's similar. But it takes inventory out of the current assets before dividing by current liabilities. So, current assets inventory, current liabilities.
Why remove inventory?
Because inventory is often the least liquid current asset. You have to sell it first, maybe collect the cash later. It can take time. The quick ratio gives a tougher test of immediate liquidity.
And the ideal here still depends.
Still depends, but the common benchmark mentioned is often around 1.1. Again, huge industry variations apply. If a business turns its inventory over very, very quickly, its quick ratio might naturally be quite close to its current ratio anyway.
Got it. Any other tips from the source on checking liquidity?
Yeah, a really practical one. Always look to see if the company is using an overdraft facility and how much, especially at the year end.
Why is that so important?
Because an overdraft signals they might be tight on cash day to day. Plus, overdrafts are usually expensive forms of borrowing. And critically, they are often repayable on demand by the bank. That adds a layer of risk that the simple ratios might not fully reveal.
That's a great point. It's looking beyond just the ratio calculation again. And building on liquidity, the source also gets into managing the components, receivables, payables, inventory, the whole working capital cycle.
Right. These are often shown as days ratios, giving you a feel for the speed of the cash cycle. First up, receivables days or debtor days.
How long it takes customers to pay you.
Essentially, yes. Calculated as trade receivables divided by your credit revenue, then multiplied by 365. Generally, shorter is better for your cash flow. You get your money faster.
But not always possible.
Well, strategy plays a part, as the source notes. Think of a furniture store selling sofas. They might deliberately offer long credit periods as a sales tactic. That will naturally mean longer receivables days.
So the change is what matters.
The change. And the reason for it. Are receivables days getting shorter? Maybe credit control has improved, or they're offering discounts for prompt payment. Are they getting longer? That could be a warning sign. Maybe credit control is slipping, or customers are struggling to pay, increasing the risk of bad debts.
Okay. And the flip side, payables days. How long you take to pay suppliers.
Exactly. Trade payables divided by credit purchases or often cost of sales is used as a proxy if purchase figures aren't available times 365.
And here, longer is better for my cash flow, right? Holding on to cash longer.
It is, up to a point. An increasing payables period could suggest the company is stretching out payments because it's short on cash, effectively using suppliers as a free source of finance.
But that sounds risky.
It can be. The source emphasizes you have to stay within the agreed credit terms. Pushing it too far damages relationships with suppliers. They might cut you off or charge higher prices. Conversely, if payables days are decreasing, maybe suppliers are tightening their terms, or perhaps the company has plenty of cash and is choosing to pay early, maybe to grab settlement discounts.
Makes sense. And the last one in this cycle, inventory days.
Inventory holding period. That's your closing inventory, or sometimes average inventory divided by the cost of sales times 365. How long on average does stock sit around before being sold?
And lower is usually better here. Less cash tied up.
Generally, yes. Less cash tied up in stock, lower risk of theft, damage, or the inventory becoming obsolete. So, efficiency-wise, fewer days are often preferred. However, and the article makes this vital point, a business must hold enough inventory to actually meet customer demand.
Right. You can't sell from an empty shelf.
Precisely. Running out of stock means lost sales and unhappy customers. So it's a balancing act between efficiency keeping days low and effectiveness making sure you have what customers want when they want it.
Okay, that paints a clear picture of that working capital cycle. So the final big bucket from the source was gearing. This tells us about risk, long-term funding structure.
Yeah, gearing or leverage. It looks at how much of the company's funding comes from borrowing compared to equity.
How's it calculated?
There are a couple of common ways mentioned, like debt divided by equity, or sometimes debt divided by the total of debt plus equity. Whichever way you cut it, it's showing the proportion of debt in the long-term capital structure.
And why does that matter? What's it telling us?
It's fundamentally about risk. As the source explains, the more debt a company has, the higher its financial risk.
Why risk?
Because debt comes with fixed obligations. You have to make those interest payments and you have to repay the principal eventually, regardless of whether the company's making profits or not. Equity doesn't have that fixed demand. So higher debt means more pressure, especially if trading gets tough. It can also make it harder or more expensive to borrow more in the future if you're already highly geared.
So high gearing is bad news.
Not necessarily, and this is an important nuance the article raises. High gearing isn't automatically a sign of trouble.
Oh.
It might be perfectly acceptable, for instance, if the business has a lot of valuable, tangible, non-current assets, property, machinery that provide good security for that debt.
So the lenders feel safer.
Exactly. Also, if the company is consistently profitable and generating enough cash to comfortably cover its interest payments, there's another ratio called interest cover that measures this. Though the formula isn't detailed here, then even a high level of debt might be quite manageable. Could even be beneficial if the company earns a higher return on the borrowed money than the interest it's paying.
Right. It really does keep coming back to that core idea. Like, you can't just look at a ratio in isolation. It's all about the context, the story behind it.
That's exactly it.
Yeah.
It sounds like the main takeaway from this article is that these ratios, they're fantastic diagnostic tools, powerful even, but they are only ever part of the picture.
They give you clues, not answers.
Precisely phrased. The source concludes very clearly that there's no single right answer that just pops out from the calculations. A really insightful analysis comes from the discussion, talking about the possible reasons why the ratios have changed, and, crucially, tying those reasons back to the specific things happening in the business, the scenario information you're given. It's all about understanding the why.
So, for you listening, what does this all mean? I guess the challenge is, the next time you see financial numbers, maybe a ratio flashing up on a news report, a profit figure from a company, or even a full set of accounts, try to push beyond just the number itself. Don't just note if it went up or down. Ask yourself, okay, what might have happened here? What decisions, what market changes, what events could have caused these figures to look this way? What story are these numbers trying to tell me about this business's health, its strategy, maybe its challenges?
Yeah.
That's the shift, isn't it?
Yeah.
From just seeing the data to actually starting to understand the business itself.